Stop scrolling for just a moment, because what's happening in the silver market right now isn't just another price move. It's not just another milestone that financial media will forget about next week. What we're witnessing is the kind of structural shift that creates two groups of people: those who recognized what was happening early and positioned accordingly, and those who will spend the next 5 years saying, "I knew I should have paid attention." Silver just crossed $100 per ounce in early 2026, and the way it happened, the forces driving it, and most importantly, what happens next, that's a story most investors are going to completely misread. This video is going to make sure you're not one of them. In the next 15 minutes, I'm going to walk you through exactly why this rally is fundamentally different from every silver surge that came before it. I'm going to show you the 3 signals that tell you whether this move has legs or whether we're headed for a sharp correction that traps late buyers. I'm going to break down what Bank of America's $60 fundamental estimate really means and why the market is ignoring it. And then I'm going to give you the framework for separating the mining companies that will turn this price into durable profits from the ones whose valuations will collapse the moment momentum fades. Because here's what nobody is telling you. Being exposed to silver right now and being positioned correctly in silver are 2 completely different things. Before we go deeper, if you're getting value from this analysis, if these breakdowns are helping you make better investment decisions, I need you to hit the subscribe button right now. We're building something here, a community of investors who want data, who want frameworks, who want analysis that cuts through the noise. Your subscription costs you nothing, but it helps us bring you better research, better data, better content. Subscribe, hit the notification bell, and let's get into what just happened. $106 per ounce. That's where silver touched before pulling back to trade around 109. Now, I want you to understand the scale of what that represents. Silver spent most of the last decade trading between $15 and $30. The idea that we would be here, above 100, was considered fantasy by mainstream analysts as recently as late 2024. But forget the absolute number for a moment. Look at the velocity. 40% gain in the opening weeks of 2026, 147% surge throughout 2025, 50% in January alone. This isn't normal price discovery. This isn't a market calmly adjusting to new information. This is a market that has shifted into a completely different regime. When markets enter this mode, they create 2 things simultaneously: extraordinary opportunities and catastrophic risks. And the difference between which one you experience comes down to how you're positioned and whether you understand what's actually driving the move. So what's really happening here? Start with the foundation, the dollar. Because silver isn't just going up, the dollar is going down. And it's going down in a way that's making some very powerful institutions very nervous. The dollar index just hit a 4-month low around 97.16. Now, if you don't follow currency markets, that might sound like boring technical data. But here's what it actually means. Every time the dollar weakens, commodities priced in dollars become cheaper for buyers outside the United States. A buyer in China, India, or Germany can suddenly afford more silver for the same amount of their local currency. That creates a self-reinforcing cycle. Weaker dollar makes silver attractive. International buyers surge in, price rises, more headlines get written, momentum traders pile on, and the cycle accelerates. That feedback loop is running at full speed right now. But here's where it gets critical, and this is the part most people are missing. Reuters reported that the New York Federal Reserve reached out to dealers on Friday to check on dollar-yen exchange rates. In currency markets, that kind of call is a signal. It's often viewed as a precursor to intervention. It means someone at the Fed wanted to understand positioning. It means they're watching closely enough to pick up the phone. When intervention talk starts circulating, trader behavior changes. People who were comfortable shorting the dollar get nervous. Capital that was waiting on the sidelines sees an opportunity. And precious metals, assets that can't be printed by a central bank, become the destination for money that's losing faith in fiat currencies. Now, let's separate the noise from the signal, because there are 2 completely different stories happening in silver right now, and you need to understand both. The structural story. Silver has been in supply deficit every single year since 2018. Last year's deficit reached nearly 20%. Industrial demand now accounts for around 60% of total consumption. Every solar panel needs silver. Every electric vehicle charging system needs silver. Every data center needs silver. This is real demand from real industries that cannot substitute easily. And here's the supply constraint nobody talks about. Roughly 3/4 of new silver supply comes as a byproduct of mining copper, zinc, and lead. Silver miners don't control production volume. Copper miners do. When silver demand surges, supply doesn't magically increase to meet it. Supply responds slowly, reluctantly, constrained by decisions made years ago about which mines to develop. That's the structural case. It's real. It's compelling. It supports higher prices over the long term. But then there's the speculative story. The silver market has a total value of roughly $5.3 trillion. Compare that to gold's $33 trillion footprint. Silver is a small market. Small markets move faster. Small markets attract speculators who know they can push price with concentrated bets. Right now, speculative positioning has become a dominant force. Intraday swings of several dollars within minutes have become common. That kind of volatility creates both opportunity and danger. Because when everyone is bullish, when everyone is leveraged, when everyone agrees this is going higher, that's precisely when the market sets the trap. Bank of America estimates fundamentally justified silver prices around $60 per ounce. That means current levels above $100 reflect momentum and positioning, not just industrial fundamentals. The gold-silver ratio has compressed to 50-1, down from 105-1 in April. That's the lowest reading in 14 years. When ratios compress this sharply, mean reversion risk increases. Technical analysts are warning that the rapid nature of silver's gains positions it for a potentially major correction. BNP Paribas strategists noted that profit-taking following what they called the frenzied nature of the rally is likely sooner rather than later. Here's the pattern I've seen repeatedly in precious metals. Price runs, retail piles in, leverage builds, something triggers a reversal, maybe a margin hike, maybe a headline, maybe just profit-taking by large players, and then the cascade begins. People using borrowed money get forced to sell. Their selling pushes price down. Lower prices trigger more margin calls, more forced selling, more downward pressure. The cycle feeds on itself until leverage is cleared. That's why the most dangerous moment in a bull market is when everyone agrees it's a bull market. When everyone is positioned one way, there's no one left to buy. And when there's no one left to buy, the only direction is down, at least temporarily. So how do you navigate this? How do you participate in the upside without getting destroyed by the volatility? Here's the framework, and I want you to save this because it could prevent a very expensive mistake. First, know who you are. Are you a trader or a long-term accumulator? These are different games with different rules. If you're trading, you respect volatility, you use stops, you size positions based on what you can afford to lose, not what you want to make. You plan exits before you enter. If you're a long-term holder, you think completely differently. You expect pullbacks, you welcome pullbacks. You see a 15% drop as a buying opportunity, not a disaster. You've made peace with volatility because you understand it's the price of admission for the returns silver can deliver. Second, watch the right signals. Most people watch price. Price is lagging. If you want to anticipate what's next, watch what's underneath. Watch the spread between spot and futures. Watch lease rates. Watch premiums in physical markets. If buyers in Asia are paying $5 or $10 above paper price to get actual metal, that divergence matters. That tells you physical and paper are not the same game. Third, manage leverage. This is where smart people with correct thesis still lose money. Exchanges can raise margin requirements overnight. They can change rules. If you're leveraged heavily because you got greedy during the rally, you need to fix that now before the next headline hits. Now let's talk about mining equities, because this is where execution separates winners from losers. The market is beginning to differentiate between companies that can convert elevated prices into durable cash flow and those whose valuations depend entirely on sustained momentum. At $100 silver, what matters is not exposure. What matters is execution capability. Companies with funded balance sheets, permitted projects, and near-term construction timelines can capitalize on current conditions without depending on favorable financing windows. Companies like Vizsla Silver, with over $400 million in cash and permits expected in Q2 or Q3, can move quickly once regulatory approvals come through. Operating producers with credible cost control are capturing margin expansion immediately. Companies like America's Gold and Silver, which increased production 52% year over year to 2.65 million ounces, are demonstrating operational leverage. At $10.60 all-in sustaining costs and $100 silver, the cash flow generation is substantial. But exploration stage companies face a different test. Resource growth alone doesn't justify valuation anymore. The market wants to see pathways to economic studies, permitting strategies and metallurgical work that converts discoveries into credible mine plans. Companies that can demonstrate this, like Capitan Silver with strategic consolidation creating a complete mineral system, maintain investor support. Those that cannot face sharp valuation compression when momentum fades. Several catalysts could drive major moves in either direction over the coming weeks. COMEX inventories declined 114 million ounces from October peaks to 418 million ounces by year-end, the lowest since March. Analysts expect continued outflows following tariff policy clarity in mid-January. If physical market tightness eases further, that removes one support pillar. Geopolitical uncertainty continues to escalate. The administration's tariff threats, ongoing trade tensions, and currency market volatility all feed safe haven demand. Every escalation drives capital into assets that don't depend on government promises. The nature of buyers is also changing. A year ago, this was primarily speculative flows. Now, industrial buyers securing supply, sovereign entities building strategic reserves, and long-term allocators positioning for the next decade or entering the market, these buyers don't panic. They don't watch candlestick charts. They measure security of supply. When they show up in size, they create a floor that speculative selling can't easily break. Here's what this comes down to. You have speculative froth on the surface. You have structural demand underneath. You have a currency crisis accelerating in the background. You have a metal and supply deficit for nearly a decade. All of these forces are colliding right now. The question isn't whether silver can go higher. The question is which companies can deliver if prices hold, and which can survive if a 25 to 35% correction materializes. The question is whether you're positioned to capture upside while protecting against downside. The question is whether you understand the difference between momentum and value. This is not a normal week. This is not a normal price environment. This is a turning point. And the investors who recognize that, who position accordingly, who stay disciplined when others panic, those are the investors who will look back on this moment as the setup for the most profitable trade of the decade. If you're still watching, that tells me you're serious about understanding this market. You're not here for hype. You're here for analysis. That's exactly who this channel is built for. Hit subscribe right now. Join this community. We're tracking every development, every signal, every catalyst that matters for precious metals in 2026. This is going to be the most important year for silver in a generation, and I want you here for every step. I want to hear from you. Drop a comment right now. Do you think silver pulls back before the next leg, or are we going straight to 150? What's your positioning? What's your strategy? Share your thinking, because when this community collaborates, everyone benefits. The transition from speculation to execution in silver is happening right now. The companies that demonstrate delivery capability and financial resilience will lead the next phase. Position accordingly. Stay disciplined. And remember, the biggest gains go to the people who were prepared before the crowd figured out what was happening.